Hi everyone, Matt Isbister here from Isbister Financial Services. Capital gains tax is the hot topic at the moment, so I thought I would share my thoughts with the final paper that's been released by the group focusing on tax. I'll try and keep it as brief as possible because I can imagine, tax is just too exciting for some people to talk about. I really enjoy talking about tax. It can have a huge impact on everyone for the better or worse, and depending on how it's treated can have major impacts. So I thought I'd quickly summarize my thoughts for you as quickly as I possibly could. So let's just look at the purpose of the working group. In terms of what the government asked them to do, they asked them to look at having a tax system that is efficient, fair, and simple, promote long-term sustainability and productivity of the economy, and support the government's revenue to pay for things that we all need: infrastructure, hospitals, schools, police, all that good stuff. Treats income and assets in a fair and balanced way, is progressive, and operates simply. Okay, so those are the terms of reference and what the government was trying to achieve. Okay, so out of the report, let's look at what they're recommending is taxed and not taxed. So what will be taxed? Land and property, including property overseas. The only exception will be the family home. Shares held directly in listed companies, any gains from those. Shares that are held within a PI or KiwiSaver fund will be exempt from capital gains tax. Sale of goodwill and trademarks will be taxed when the business is sold. And the sale of business assets that produce income, plant and equipment, will be sold. So not your stock. Again, excluded will be personal home and personal valuables such as art collections and jewelry and that sort of thing. So when you look at that, that's a pretty large list of what will be taxed. And let's also, I'll describe to you what a capital gains tax is as well. So when you buy something, say you buy a house at 100,000, and then you sell it for 150,000, you're taxed on the profit that you have made on that property. So the $50,000 profit will be taxed at the highest marginal tax rate, 30%. So you pay around about 15 grand tax on that profit that you've made, or just over. So I guess now that we know all the facts, what are going to be the implications? Firstly, is it efficient and fair? I don't know that it's efficient, and I certainly don't think it's fair, but I'll get to that point a little bit later on. Promote sustainability and productivity of the economy. I don't think it's going to change much at all, to be honest. We're still going to invest a lot of our wealth into property under this regime, whereas we as a country need to be investing more into productive assets. Productive assets are assets that generate income, that they produce goods that are sold overseas, generates income for the country. They're good assets for the country. It's not going to deter people from investing in property. I mean, a capital gains tax, you're taxed on your profit. If you're making a profit, you're still going to be happy. You're just not going to be as happy because you're having to give away some of your money to the government. So people are still going to dump a lot of money into property, which is a non-productive asset. It's a lazy asset. It's only productive when companies and businesses are building the house or renovating the house. Other than that, lazy asset does nothing much other than provide accommodation, which is what it should be doing. Will it support revenue for the government? Yes, it will, because the government will earn more off the tax that it gets from the capital gains. Treat all income and assets in a fair and balanced way. No, it won't, because people will still invest their wealth into property, using property or equity they already have. Those that don't have property or equity will still struggle. And so that's what's not going to be fair about it. They will struggle to get onto the ladder as they are doing now. It will do nothing to make housing more affordable, again, because speculators will still exist, land bankers will still exist. In fact, you could argue that more people will hold on to property because of a capital gains tax. They will look to hold on to it for as long as possible to avoid paying the tax. Is progressive and it operates simply. Well, it's progressive. It's looking at different options, but operating simply, no. And I'll give you an example of why it's not operating simply. If you look through the document, there's many examples of what is included and what is excluded as a family home. They're going to tax someone that lives on a farm, for example. How they will measure that is your primary residence will be excluded, but the land surrounding your house and primary residence that isn't part of your gardens will be deemed as a taxable asset. And they will determine that by the size of your garden that sits outside your property. I mean, that's going to cause a heck of a lot of complexity around what's going to be taxed, what's not going to be, what's the boundary. You'll probably have farmers extending their gardens to reduce the tax that they have to pay. There's also other issues around if you're building a house, you've got 12 months to sell a house. If you're building a house and it takes longer than 12 months, if you live overseas and hold assets here, it brings in a whole heap of complexity to the current tax system. So I'm sure accountants will love it, but in general, the public are not going to be happy with all this additional complexity. So it's really, from what I can see, it's not going to hit the mark. And I think the other thing that it's potentially going to do is deter overseas investors from investing in businesses in New Zealand. And those are productive businesses, which we want and need. I mean, if you're an overseas investor, even if you're a local and you're trying to attract capital or funding to your business to kick it off the ground or keep it going, and an international investor looks at, how easy it is to invest, what are the implications and what are the incentives, and they see that they're going to be stung with a capital gains tax when they sell their shareholding in that business, they're going to be thinking twice about investing into that business. Now, I can sort of understand potentially property, even though I don't agree with that either. Different topic, different subject. But we want to attract international capital, international money into New Zealand businesses so that we can grow our economy. So that is stupid, in my view. And I don't think that will happen anyway. I think, they're doing this as part of a negotiation process of, hey, we're going to tax everything. And then when it comes down to it, they'll probably just bring in the capital gains tax on the sale of property and maybe one or two other things. So yeah, in summary, I don't like it. I don't think it will do the job that they are wanting it to do. I think, you add this to the botched up home build program, and Jacinda, who is the ultimate PR machine, might be starting to write letters in the vein of Colin Craig. There is only one of me, but instead of I wish there was two, she should be writing there is only one of me, but I wish there was 30 so that I could do the jobs of all my ministers. Because the stuff that we're seeing from them around housing and taxes and the economy is actually incompetence. They have advisors that advise them on this stuff. It is utter incompetence to have something like this produced and not have an answer, to even be buying into this rubbish, because this is not going to achieve what they want it to achieve. There are other much better mechanisms to achieve what they're looking to do. Another topic. Thanks for your time, and look forward to catching up with you again soon.